something surprising just happened in Singapore's finances. A massive shift in tax revenue has turned a deficit into a surplus by billions. But here's the big question. Can Singapore's booming tax collections last, or is this just a temporary windfall? Welcome to 2230. Before we dive in, don't forget to like, share, and subscribe to stay updated with the latest news that matters. And we want to hear your thoughts. Drop a comment below as we discuss how this affects Singapore's future. Singapore's national budget for 2025 has revealed a stunning turnaround in the country's finances. Initially, the government projected a 2.6 billion Singapore dollar deficit for FY 2023, but instead, Singapore has recorded a 6.4 billion Singapore dollars surplus, thanks largely to one unexpected source: corporate income tax. Corporate tax revenue hit 30.9 billion Singapore dollars, a 6.5% increase from the previous year, and it has now surpassed even the net investment returns contribution, NIRC, as Singapore's biggest revenue source. The NIRC, which allows the government to use returns from past reserves, stood at 24 billion Singapore dollars, a strong figure but not enough to keep up with surging corporate tax collections. But why did corporate tax revenue surge? The answer lies in cyclical economic factors, a booming finance sector, and strategic investments from multinational enterprises, MNEs, looking for a stable business environment. Singapore has been attracting high-value operations from global companies, which has likely contributed to this unexpected tax windfall. And it's not just corporate tax that's up. GST revenue soared by 23.8% to reach 20.6 billion Singapore dollars, thanks to stronger-than-expected consumer spending. Personal income tax collections also jumped 8.3% to 19 billion Singapore dollars, driven by rising wages. Now, let's go back to 2022. Remember the heated debate over Singapore's GST hike? Back then, PM and Finance Minister Lawrence Wong defended the increase, arguing that raising corporate and wealth taxes alone wouldn't be enough to sustain government spending. Despite opposition proposals for alternative revenue sources, the government pushed ahead with the GST hike, from 7% to 8% in 2023, and then to 9% in 2024. Fast forward to today, revenues are up, but so is government spending. In December 2023, Singapore provided 3 billion Singapore dollars in MediSave top-ups to help citizens manage rising healthcare costs, including increased MediShield life premiums. Other major expenditures include Changi Terminal 5's development and energy transition projects. Looking ahead, Singapore is projected to have a 6.8 billion Singapore dollar surplus in FY 2025, and revenue may rise even further in FY 2027 when the government implements a domestic top-up tax, setting a minimum 15% tax rate for large MNEs. But there's a catch. With global tax policies shifting, especially after Donald Trump's recent rejection of the global corporate minimum tax deal in the US, the revenue forecast remains uncertain. Will Singapore continue to be an attractive base for MNEs, or will companies start looking elsewhere? What do you think? Will Singapore's tax revenue continue to grow, or are we looking at a temporary high? And was the GST hike necessary, or could alternative revenue sources have worked? Let us know in the comments. For more deep dives into Singapore's biggest news, hit that subscribe button and turn on notifications so you never miss an update.